Congratulations, President Trump, and welcome back to the White House. Now, that might not be the words you wanted to hear. Maybe you were voting for the other side. But the reality is I was a Marine, and as a Marine, we were taught to always protect the Commander-in-Chief. So the Commander-in-Chief now is once again President Trump. But how is this going to affect us going forward? What do Trump's tax policies mean for your future? I'll look at tax policy implications for 2024 and beyond. Now, no one could tell you exactly what all of this means, but let's take a look back at what the introduction to Trump tax approach was. The overview of Trump's previous tax cuts, the 2017 Tax Cut and Job Act, the goal was to lower corporate and individual taxes and boost the economy and incentivize investments. Let's take a look at the facts. The Tax Cuts Job Act brought major changes to the tax code for both businesses and individuals, and it simplified it in many ways. The permanent tax cuts to corporate profits. It lowered individual tax rates by restructuring the tax structure brackets entirely. It brought the standard deduction from $13,000 to $24,000. Now, this for many people made it so that they didn't even have to itemize anymore, simplifying the tax code greatly. It doubled the lifetime gift and estate tax exemption from 5.6 to 11.2 million, and right now it's over $13 million per person. The possible individual tax cuts, the proposal is to lower marginal tax rates similar to 2017 cuts. It reduced the tax bills for higher income earners and potential extension of 2017 cuts for individuals. The possible shifts increased tax favored accounts, more flexibility in 401ks and IRA contributions, an impact on average retirees. More tax-deferred saving options could improve retirement readiness. Social Security and Medicare, well, potential funding adjustments, a push for privatization of funding shifts. Now, there is a risk, potential impact on future Social Security benefits and Medicare adjustments. But one of the things that he said during his campaigning is that he would try to eliminate taxes on Social Security. Now, whether this is going to happen or not, it's anybody's news at this point. But the reality is that he's headed in the direction that we want to go if we are retiring or nearing retirement and we want to get our money over to tax-free. Taxes and capital gains. Capital gains, potential cuts to capital gain taxes appealing to investors. Retirement impact encourages higher returns on retirement accounts. Estate and wealth transfer. Estate tax reforms, possible elimination or reduction of estate tax. Impact, beneficial for a wealth transfer with mixed effects on lower to middle income retirees. Now, the interesting thing about this is what is the definition of wealthy today? See, I used to think when I was a kid that having $1 million was a lot of money, but I'm telling you folks, there are hundreds and thousands and millions of millionaires out there today. So at what point do you say, well, we're going to take a portion of whatever you transfer on, and having this wealth transfer tax can really devastate some families. After the election, there will only be going to be a major tax debate with trillions of dollars on the table, said Chuck Marr, Vice President of Federal Tax Policies for the Center on Budget and Policy Priorities. Now, here's where we're at. This is where we were at up to 2024. And now that Trump has become president, it's a good chance they'll sunset the law, but what they'll do is they'll rewrite that law, and with a little bit of luck, they'll carry that law forward. Now, what does that mean, sunset the law? Well, 12/31 of 2025, which is this coming year, will mean that at this point, your tax brackets will go back to what they were pre-2017, which were quite a bit higher. In addition to that, that would eliminate that standard deduction inside of there. There were several changes in there that would raise everybody's taxes. Now that he's back in office, what that would mean is that most likely he would carry that forward. How long would he carry it forward for? Probably a minimum of 4 years, more likely 8 years. Now, folks, this is an opportunity. This is a huge opportunity. This is an opportunity for you to now get proactive where you may have missed this opportunity before and start moving more and more money over to tax-free. Now, why? Well, because the highest income taxes have ever been in the United States is 94%. The average has been 57%, and currently we're sitting at 37%. We have a national debt of $35 trillion. We spent $2 trillion more than we actually brought in. We've got an unfunded deficit of 220 some trillion dollars. We're basically $255 trillion upside down with a $5 trillion budget. So I don't know. What do you think? You think tax rates are going to be lower, higher, or same in the future? There really are only 3 ways to grow your money. You can grow your money in a tax-as-you-go environment. This is where you get a 1099 every single year. It's cash, savings, certificates of disappointment, bonds, anything that creates a 1099. You can grow your money in a tax-deferred account. This is what we call qualified money. Your 401ks, your IRAs, 403bs, 457, defined benefit plan. And in addition to that, any tax-deferred annuities. So money you took out of your tax account, put it in an annuity, it's now growing tax-deferred. Now, the third way we can grow our money is in a tax-free environment. And in that tax-free environment, we have 529 plans, Roth IRAs, and maximum funded life insurance policies, as well as muni bonds. So here are the 3 actions that you should be taking now. And I mean literally now. Many of you waited up to this last minute to find out, well, who would be president, etc. And then you found out that you should have been doing Roth conversions a long time ago, moving money to tax-free a long time ago. And now you're just starting to go, oh, maybe I should have been doing that earlier. Well, now, folks, you're going to probably have a little bit longer runway. Don't wait. Get that done as soon as you possibly can, because things can and will change. Converting to a traditional IRA over to a Roth IRA should be one of your first steps. How much should you convert? Well, at the end of this, you're going to have the opportunity to go out and purchase a Roth conversion class. A class simply on that subject, and then learn where and how much you should convert over to your Roth IRAs. What is a qualified money? Well, qualified money is tax deferred. The exceptions to qualified money that are not tax deferred would be a Roth IRA. A Roth IRA is also qualified, but it's tax free. But all IRAs, SEPs, 401ks, 403bs, 457, defined benefit plans, these are all what are called qualified money. There's penalties for taking them prior to 59 and a half. You must start taking them at age 72, 73, 74, or 75, depending upon what your age is. Otherwise, there's a penalty for not taking it out. Non-qualified is taxed as you earn. It's a non-government qualified plan, so some exceptions are certain bonds. CDs, stocks, bonds, mutual funds, etc. are also non-qualified money. So what are the benefits to a Roth IRA? Well, it's tax-free. It's not only tax-free now, it's tax-free forever. So when you pass it on, it passes on tax-free. There are no required minimum distributions. You can still contribute to it past your RMD age. Roth conversions cannot be reversed. So with the new Secure Act, if prior to the Secure Act, you could actually do a Roth conversion and do what was called a recharacterization and put the money back. That is no longer an option. Roth IRA funds pass on tax-free to beneficiaries, as I already mentioned. Beneficiaries can stretch the income for tax-free for 10 years. No taxation on distribution at trust rates. It removes the uncertainty of what future tax rates might be, and it offsetting the losses in the market. Who should convert? Well, anyone who has a traditional IRA. A beneficiary of an IRA is a trust. Wealthy people who don't need, want, or likely not use RMDs or distribution in their lifetime. Now, if you're one of these people and you're a high net worth individual and you're not going to use your IRAs, then it's a high likelihood that we should be doing something besides converting to a Roth IRA. We probably should be using some form of life or death insurance to make that much more spectacular than a Roth would be. You believe you will be in the same or higher tax bracket in distribution years. Now, if you don't know this, then it's time to sit down and have a meeting with us so that we can show you what your tax brackets will look like going forward. You have access to outside funds, non-qualified to pay the taxes. This is not always necessary, but the best way to do a Roth conversion is to use outside funds to pay the taxes. You can also use the funds inside the IRA depending upon your age. How will the tax work? Well, IRAs converted in 2024, taxes is due April 15th of 2025. Converted in 25, April 15, 2026. It's important to know that taxes will likely go up and income may have an effect on Social Security, AMT, and all other incomes, as well as your Medicare, etc. And these are all things that you need to be sitting down and having a plan and then running that plan past whoever does your tax preparation to make sure that your numbers are correct before you do it. Partial conversions. You are not required to convert the entire amount of your IRA. You can convert it in small amounts over a several year period. This is as of today. The results may change in the future. And in addition to that, depending on what type of account it is, they may force you to convert the whole amount. You may not be able to convert partials in that account. So actions to take. Grow your money in tax-free with properly structured, maximum funded index universal life. Once you've done your conversions and you've got your money over to a Roth IRA, you still got money sitting over in these accounts over here, you want to get into tax-free, this is a fantastic way to do it. It may also be that you use this technique as opposed to converting to a Roth, you use what's called a rollout, and you roll it out to a maximum funded life insurance policy. There's a lot to learn here. You can go out, we have a course just on this subject. Go to our website, look under life insurance, look under courses, and you'll find a course just on that subject. What is an IUL? Well, an IUL is unlike traditional life insurance policies. It allows you to allocate a portion of premiums to a savings account which is invested in a variety of market indexes. In other words, it gets the gains of the market up to caps, spreads, and participation rates with a floor of 0, meaning you never participate in the losses. So when the market goes up, you get a gain. When the market goes down, you do not get losses. The indexes perform well, the cash value grows significantly, and if you perform poorly, you make 0, you lose 0. So how does a Roth compare to an IUL? Well, they both grow tax-free. You can access both of them tax-free. However, when I'm accessing money from an IUL, I can use it much like a bank account in that I can take the money out and I can put it back. And it's even better than that because I can actually leverage that money. I can put a lot more into an IUL than I can put into Roth. I don't have limitations. Access of money, more liquidity, indexing never loses when the market drops, and when you die, the value blossoms up to a higher amount that's tax-free to your heirs. This is a sample of indexing right here. You can see in 2000, 2001, 2002, when the market went down, we went sideways. We come off of wherever we started at, whereas the person that was in the market has to start down here at a much lower point. And then in addition to that, what happens is they have a 5-year run up. 2008 happened, and you can see in this example right here, if you'd have taken $100,000 and invested it in the market and $100,000 invested in an IUL policy, today, out of 2017, you would have been $352,000 as opposed to $181. All tax-free. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. Mr. Warren Buffett. Now, this is not new stuff, folks. This has been around for a long time. It's a very big portion of the tax law. IRC Section 101A, 7702, 72E. These are all portions of the tax law that determine how much you can put in a life insurance policy, how little insurance you can buy, and how that works. Matter of fact, one of my mentors of all time, Mr. Ed Slott, says that the single biggest benefit in tax code is the tax exemption for life insurance. So what are the actions you need to take? Well, set up a no-cost, no-obligation strategy session to get with me and get clarity on your plan. We'll sit down and we'll show you what your retirement looks like, what it will look like going forward, what your tax brackets will look like going forward. You want to know more than that? Go out to our website, go under courses, pick up the course on Roth conversion, annuities, life insurance, whichever one you want, and learn it that way. Or you literally can sit down with me and I'll explain it to you and I'll show it to you based on your numbers. I've been a wealth advisor for more than 20 years. I was a master lead advisor for Mr. Ed Slott for more than 9 years. Top of the table member for MDRT. MDRT is a $1 million roundtable. It is the most prestigious financial planning institution in the world. It's the top 5% of all planners in the world, and if you're the at the top of the table, you're in the top 1%. Ex-Marine, past, well, I'm still a Rotarian, but past president of my Rotary Club. And all you got to do, folks, is scan this code and go out and set up the time. Now, once you do that, it will send you out a wealth assessment form. When you get that wealth assessment form, fill that out as complete as you possibly can. Get it back to us at least 72 hours prior to that meeting so that we can have some numbers prepared for you and you don't have to watch me work as we go. Now, once again, I'd like to congratulate President Trump. And whether you like him or whether you don't like him, now we have a new set of rules that we're going to work by for at least the next 4 years. The question is, are you going to be proactive or reactive? What are you going to do with this opportunity that's just been laid out in front of you? Remember to subscribe to our channel. Remember to live like you're going to die tomorrow and plan like you're going to live forever, because you just might. Keep smiling, and I'll see you soon.